Thank you very much, Kelvin. And thank you to the entire team at Helm for putting this together and for having me here today. It's really exciting to be here with all of you. And thanks to all of you that have taken some time out of your day to be here. I'm an entrepreneur myself. I understand what it means to take time out from my business or from my family to be on things like this. And so I don't take that lightly. And I want to make sure that in the next 60 minutes, I give you as much value as I possibly can as it relates to what's probably one of the least exciting parts of running a service business, which is figuring out the numbers side of it. And I'm not, blissfully unaware of this. I know that what we sell is broccoli. And the stuff that Christian talks about is much more of the chocolate of the business. It's much more exciting to go out and sell things and get big clients. But as most of us have probably experienced at some point in our agency's life cycle, if we don't get the numbers right, it can cause a lot of problems and it can make it a lot less fun to run the business. So that's my commitment for today, is to really run you through how to measure the basics in your agency. So a little bit about me before we get into this. This is basically what I do. I run a company called Parakeeta, where we help digital agencies measure and improve their profitability. We do a host of consulting services, one of which is actually building and then maintaining and running their systems for measuring their financial and non-financial KPIs. I'm also the fractional COO at Goldfront, which is an award-winning creative agency out of San Francisco that does work for clients like Uber, Slack, Nike, Adobe, etc. I run a podcast called the Agency Profit Podcast, where, you guessed it, we talk about agency profitability. I'm also fortunate to be the head strategic coach at SaaS Academy, so I know a thing or two about software as a service as well. And I get to do this pretty often, coming on virtual stages and physical stages, podcasts, and so on, to teach what I know. And this is my favorite way to market. I mean, let's all be honest, I'm marketing to you right now, but I fundamentally believe that our marketing should serve more people than our product ever does. So rest assured that my thesis here is that I'm not just going to try and sell you something today. I'm going to try and answer some really important questions that you probably have as it relates to measuring your performance in your business. So the problem that most of the people I talk to experience when it comes to measuring these things is, number one, there's no clear strategy or vision when it comes to measuring performance. So it's really unclear, what should we be measuring? What metrics should we pay attention to? How should we calculate those? How often should we look at them? And what are kind of the nuances of these things? And a good example of this would be a metric like utilization. We've all probably heard the term utilization rate. When we start double clicking on that metric and we ask, okay, well, what exactly is somebody's capacity? What's included in that? What's not included in that? Are we including weekends and holidays and paid time off and sick days and non-billable time? What is somebody's capacity? It gets very nuanced. And the same thing is true about something like a billable hour. What is a billable hour? And when I ask agency owners or even different executives within the same agency, I often get different answers to these things. So it's very important that we get some clarity on exactly what to measure and how, so we can get some consistency and we can focus our energy and efforts measuring the things that truly matter. The other challenge that I find is that even if there is a sense of what we want to measure, the data is something that we feel like we're fighting against. And so we might not feel like we have the right tools or the right infrastructure in place, the time tracking or invoicing or project management data that we're trying to use to get these things always feels like it's very messy and disconjointed. And it takes a lot of time and energy to clean these things up and get any kind of useful insights out of them. And because of all this, we might find ourselves guessing and stressing when it comes to important decisions in our business, like, should we discount this project in order to get this work in the door? Should we hire this person? Should we fire this person? These are all the kinds of decisions that we're thinking through on a daily or weekly basis in the agency. Without data, it can feel like we're really making gut feel decisions, and that is not a very comforting way to make these kinds of decisions. So these are some of the things I hear a lot, but I'd love to hear from all of you in the chat. Is there anything else when you think about measuring the performance of your business or improving your profitability? What are some of the other things that you might be struggling with? I want to make sure that I can address those if I can today during the session. So let me know in the chat. While you're answering that, I'll talk through the promise for today. So we won't necessarily have time for the forecasting piece of this, given that we only have an hour today. But what I can certainly spend some time on is really getting clear on the metrics, benchmarks, and calculations for how to run and measure a profitable agency. And if we have a little bit extra time, we can talk a little bit about how to walk through the framework for setting up your tools and systems to create data that's actually very helpful in answering and measuring these benchmarks. So with that, I want to jump right in, and we're going to start with this first section, which is really getting clear on what you need to measure and how you need to measure it to improve your performance and how that actually impacts your bottom line. So there are essentially 4 key metrics for agency operations. The first is your core financials. And I'm not an accountant, I'm not a finance person. I'll be the first to tell you that, but most business owners are already spending time or money on financials, mostly because if you don't, you're probably going to end up in some trouble with the IRS. You might go to jail. So you kind of have to do financials. And this is the lowest hanging fruit for most of us when it comes to getting better visibility into the performance of our business. There are a couple of simple tweaks we can make to our financial statements that allow us to get a lot more visibility. And since we're already investing the time and money, it comes sometimes at no additional cost to us in terms of effort or time investment or money investment. So I want to start there because it's probably the easiest thing that all of you can walk away with today and get some additional value from. But then I want to talk about some non-financial metrics that we can use to get more frequent and more detailed visibility into the business in a way that's not going to be incredibly cumbersome. And that's where we want to talk about average billable rate and utilization, which are 2 really useful tools that we can use on a more frequent basis outside of our financial system to get insight into how the business is performing and get an understanding of where we need to be paying attention to make sure that we're doing things in a way that's profitable. And then finally, we have scoping accuracy, which is really a measure of how good we are at planning out work and creating estimates about client work. And like it or not, this is important because this is at the foundation of agency operations. If we understand that the goal of agency operations is to help us make decisions about the future, then we should understand that those decisions about the future are almost always based on scoping and estimates about client work. So if we're thinking about resource planning into the future, that is a function of the time, money, and effort that's required to get a project done. And we're spreading that out into the future and trying to discern if we're going to need more people, if we have the right mix of people. The same thing is true about projecting out cash flow. Oftentimes, cash flow is tied to these invoicing milestones, which is often tied to deliverables or certain points within the contract. And so all of these things are interconnected. And if we can't do a good job of predicting what it's going to take to get client work done, then we really don't have much of a foundation to build a scalable agency operations system. So these are the 4 core metrics. And so I want to start by digging into core financials first and getting some clarity on some simple tweaks you can make to your financial statements today to get more visibility out of them. And so the first thing that I want to talk to here is what are the 5 things that you should be able to really easily identify when you look at your profit and loss statement at the end of every month. And the first, of course, is your revenue. If you can't see your revenue, then you probably should be looking at hiring a new bookkeeping and accounting firm because that's about as basic as it gets. But from there, we want to really identify this other form of revenue, which is agency gross income, or AGI. And this is a term that was popularized by Drew McClellan. And really what this refers to is, again, agency gross income. And agency gross income is slightly different than revenue in that we need to subtract out what we call pass-through fees. Pass-through fees or pass-through expenses. And so what is pass-through? Essentially, it's revenue that is coming into our agency, but it doesn't actually belong to us and that we don't really need to earn with our team's time. And so good examples of this would be things like advertising spend, print budgets, perhaps money that's passing through us into other vendors like production companies, white label vendors, contractors, and freelancers. And so we want to be able to isolate those things so that we're not conflating the amount of money that we actually need to earn from the total amount of money that's coming into the business. And a good kind of extreme example of this would be if Visa believed that their revenue was all of the money that passes through Visa every month. Well, they would be grossly inflating the amount of money that business runs, because the truth is they only take about a 3% cut of all the money that flows through Visa. And so the same thing might be true about your agency if you do a lot of advertising spend or print budgets, or you have a lot of pass-through expenses. And excuse me for a moment, I have COVID and I need to drink some water. Okay, so with that said, we have got our revenue, we isolate our pass-through expenses, and generally this is going to be done using cost of goods sold in your profit and loss statement. And what that should leave you with is agency gross income. And AGI is critically important because this is the actual size of your agency. If I, for example, run a $10 million a year business, but I spend $5 million a year on Facebook ads on behalf of my client, I actually run a $5 million agency, not a $10 million agency. I don't want to be making spending decisions or trying to benchmark my margins using that $10 million number, because that's not really the size of my business. I only have to focus on earning and focus on the profitability of the money that's left over after the pass-through expenses are taken out. So the next question now is, well, what is our margin on AGI? And that's where we want to be able to measure what we call delivery margin. And this is akin to gross margin, but we use different language because accountants get mad at us when we start conflating these, very rigid accounting terms with something that's a little bit looser, like what we're talking about here. But delivery margin is essentially asking the question, what does it cost us to earn our AGI? And what is the margin on that? And this is probably the most important metric that almost no agency that we look at is measured. And so the way that we figure this out is by isolating delivery costs. And delivery costs are essentially the cost of earning our revenue. So that is mostly payroll allocations to people who do delivery work. So this is going to be your designers and copywriters and project managers, et cetera. It might be a portion of your salary as a founder. The majority of the delivery cost line is going to be payroll. Then you might also have what we call shared delivery expenses in here, which would be examples of, software, for example, that are not attributed to a single client, but are required for the delivery team to do their job. So things we see fall into this category often would be like Adobe Creative Cloud, Figma, maybe a stock footage library, maybe software that helps you run ads or design creative. Those kinds of things would fall into a delivery cost bucket as well. So the problem I see a lot of people have with this is that all of their payroll on the profit and loss statement goes to a single account, and all of their software expenses go to a single account as well. And so it's very hard for them to figure out, well, how much of that payroll did we spend on delivery? And without being able to see that, it's hard to get to this delivery margin number. So delivery margin, generally, we want to be at about 60% or more on the profit and loss statement. Really, anything above 50% is healthy, but that is the objective. And so what that really means is we want to spend less than 50 cents to earn $1 of AGI. So if we have $1 million in agency gross income coming into the business in a given period of time, we want to spend no more than $500,000 on the payroll and shared delivery expenses in order to earn that revenue. And what that does is it sets a healthy foundation for us to have enough money left over to pay for overhead, which is the next thing we're going to want to isolate here, and still have margin left over. So that leads us to the next section that we want to be able to grab from our profit and loss statement, which is overhead. And this is generally going to be referred to as expenses in your existing profit and loss statement. And the key thing here is to essentially just be able to measure what percentage of your AGI this is. And this typically, we want it to fall somewhere between 20 and 30% of AGI, with about 8 to 14% going to admin, about 8 to 14% going to sales and marketing, and about 4 to 6% going to facilities. Now, these are just guidelines. Obviously, if you run a fully remote team, you might have no facility expenses. You might choose to put more of that into sales and marketing. But really what's important here is that you keep your overhead spending to somewhere between 20 and 30% of AGI. And then whatever's left over is your operating profit. And we generally want this to be at 25% or more of your AGI. And so if you do the math here, if we have a 50% delivery margin and we spend 25% on overhead, then we should have 25% left over as profit. So that is the basic structure of a profit and loss statement and the things that you should be able to see when you get your financial statements from your accounting team every month. And typically where we see the challenges occur are at these two junctures. The difference between revenue and AGI tends to be problematic because we're not properly isolating pass-through expenses. And similarly, the difference between AGI and delivery margin tends to be challenging to see because we're not properly isolating delivery costs. So most of you, if you pull up your P&L, it should start to become obvious to you what kind of tweaks you need to make. And this is probably the easiest thing that you can do to start getting more visibility into the performance of your business. So I'm going to pause for a moment here and just answer a question from Jacinth. Sorry. This is called, this presentation tool that I'm using is just an iPad Pro, and I'm using an app called Notability. So I just drop a PDF of some slides in here, and then Notability allows me to draw on these in real time. So hopefully that answers your question. All right, I'm going to take a quick water break. Let me know so far if this is resonating, if this is making sense to you. And if you have questions, of course, drop those in the Q&A. And we're going to move on next to a quick example of how these core financials actually work together. And then we'll get into our non-financial metrics. Okay, so we've talked about core financials. I just want to go through a quick live example of what this might look like. So just so we really drive it home. So let's imagine that we have total revenue here in our business of $1.5 million. We have pass-through costs of $500K, which means that our AGI for this business is going to be $1 million. Now, if we have $400,000 in delivery costs, then that puts our delivery profit, which is a very important number, delivery profit, at $600K, or 60% of our AGI. So this is the first kind of very important measure. Delivery profit is telling us how fundamentally profitable is our service offering before we consider what is somewhat disconnected from the profitability of an individual service or project or client, which is the overhead that's needed to run the business. So this is kind of the first set of measurement that we want to do. And then as we extend from there, we will take our delivery profit and start subtracting out our overhead to get down to the net number. So let's say we spent on sales and marketing, we spent 140K, which is about 14% of AGI. We spent on admin another 100K. This would include salaries for yourself or other team members if you're allocated primarily to sales and marketing or to admin. And then on rent and facilities, we spent another 55K, which is about 5.5%. So our total overhead, you'll have to excuse my handwriting. I know it's bad. You won't be the first to tell me that, but I like to think it's like I'm a doctor. You know, doctors are really smart. They also have terrible handwriting. I like to think it's the same thing for me. So 29.5% spent on overhead, which means that our operating profit is our 600K minus our 295, which is 305K, or 30.5%. That's a very healthy agency at an operating profit of 30.5%. So this should be the easy kind of visibility that you should be able to get when you get your financial statements. So you get a sense of, is our delivery profit in good shape? And is our overhead spending balanced relative to the size of our business? And this is a really good way to get, for most of us, 12 opportunities per year to get a precise measurement of if the business is healthy or not. And just to kind of put this into perspective, the way that an agency makes money is AGI minus delivery costs minus overhead equals profit. We just went through that calculation. So of course, what's important to note here is that one of the primary levers for profitability is increasing the AGI relative to delivery costs. If we can lower our delivery costs or increase the AGI that a set amount of resources is able to earn, then we create better delivery margins, which is really the biggest lever we have to pull in order to improve our profitability, because generally there's not a whole lot of cost cutting that we can do to overhead without compromising on the quality of life in our business, or perhaps our quality of life as founders. And there just isn't that much juice in the squeeze for overhead. You might have 4, 5, 6% worth of cost savings that you can get there, which is not really going to move the needle if you're in a position where your net margins right now are 10 or 15%. We want to get outsized returns. Those outside returns come from delivery margin, which is the relationship between AGI and delivery costs. So the question that I want to ask here is, how do we get more frequent visibility into our delivery margin without using our core financials? Because the problem with core financials is, as I mentioned before, you're probably getting these maybe once a month. You're probably getting them 2 to 3 weeks after the month is over. And the other problem with core financials is that in order for these to become more precise or more frequent, generally that comes with a pretty large increase in complexity and therefore cost. So if we think about this, measuring this at the agency-wide level is pretty simple, pretty straightforward. If we want to start getting to client-level profitability, that's a little bit more complicated, but not so bad. We want to start getting to project or perhaps milestone or perhaps deliverable or perhaps department level profitability. All of these things become increasingly complex because, of course, in accounting, we have to now start segmenting our invoicing, our payroll allocations, our expenses into these buckets. So there's this exponential cost of trying to get more detailed in our financials. And of course, there's also an exponential cost to trying to get more timely in our financials, because it all basically means more and more frequent bookkeeping time. So I think the core financials are really, really important as a precise touch point for the performance of your agency, but I don't think they are the answer for getting more frequent touch points. And so I want to talk about earning efficiency or average billable rate and utilization next as tools that we can use to, on a weekly, bi-weekly, or just more frequent basis, get a sense of how things are going without requiring a whole bunch of additional complexity and cost to go into our accounting workflow. So before I go into that, is this making sense? Give me a yes in the chat if you're tracking so far, and this is making sense to you. Thank you, Adrian. Appreciate the feedback. Taylor says yes. Awesome. Glad this is tracking so far. Thank you for the engagement, folks. Marianne, yes. Okay, awesome. Appreciate that. So let's talk about these next two metrics. So earning efficiency, there's two ways to measure this. We talked about gross margin, or delivery margin, as we like to call it, which is simply our AGI minus our delivery costs divided by AGI. So an example of this would be, we have $1 million project. We spend $400K on delivery divided by 1 million. That gives us a 60% gross margin. So that's great, but all the problems I just talked about exist with this metric. It requires a lot of inputs. It's very precise, but it's kind of expensive. So how do we do this faster, cheaper, and more often? We use average billable rate. And average billable rate is such a great, simple metric that we can use to start to get patterns across any subsection of the business. It requires two very simple pieces of data. The first is AGI for a given piece of work, for a given section of work, for a given time period, and it requires the hours worked against that AGI. So for example, if I want to say, I want to look at all my website projects for the last 6 months, and I want to get a sense of what my AGI was on that, then I would go and grab that. And let's say in this example, I did, let's call it $100,000 in AGI in website projects over the last 6 months. And I spent, let's call it 800 hours on that $100,000. So that would give me an average billable rate of $125 per hour. So very important note here that this is not what we are charging the client. This is not what we are using on our rate card when we estimate things. This is what it actually was after we worked all the hours to earn the revenue. So it doesn't matter if I was only planning to spend 400 hours on this, right, which would put my average billable rate at $250. That's what I planned to do. But the reality is that it ended up taking 800. Therefore, I only earned $125 per hour. So this is a really, really useful metric because of just how simple and easy it is to calculate. And again, we can start to use this to get a sense of across any section of the business, what was the average billable rate, and start to identify areas where we are more efficient, less efficient, clients, projects, service lines that have higher or lower average billable rates. And if we have a sense of our average cost per hour, then we can run the delivery margin target on this. So in this example, if we had a $125 average billable rate and we had an average cost per hour of, let's say, $35, then we can run that same calculation, 125, and figure out roughly what our delivery margin was on that 125. So I'm going to do this math in real time. That would give me a 72% delivery margin, which is pretty damn good. I'm happy with that. So this is the first kind of non-financial metric that we can use very, very often to get more frequent touch points and more frequent visibility into where we are or aren't performing. And we can get very detailed, very granular, look at any subsection of the business. And again, do this with very little complexity. Adrian asked, do we use the hours worked by each individual labor rate? He answered my question with $35. Yeah, so of course you want to get really precise, Adrian. You can start to try to do this, at an individual level, but generally just kind of rolling this up to an average is enough to get us a directionally accurate sense of, is this a good or a bad average billable rate? And if we can set a target and gauge off of that target, the purpose of this is not to be super precise, it's just to be accurate and to get a sense of, are we on track or are we not on track? And then the precise touch point is going to be our profit and loss statement. So earning efficiency, number one. So just to run you through an example of what this looks like, we could run a report at the end of a time period and look at a few projects that we've done and see, hey, we did this website build, it was 70K. We had 20K in pass-through, so the AGI was $50,000. We spent 500 hours. That gave us an average billable rate of $100. We did a brand design project, 15K AGI for 100 hours was $150. And we did a funnel build for $10,000 in AGI, but it only took us 50 hours. So that was $200 average billable rate. So all these things, really simple numbers, but imagine having a conversation now with your team and saying, hey, team, let's talk about the funnel build. What an amazing project. You guys absolutely crushed it. We were way under budget on this. The client was happy with the deliverable. What can we learn from this project that we can apply to other ones? And similarly, we could say, hey, let's talk about this website build. It didn't really go the way that we planned. We were hoping to have, higher average billable rate. What did we miss on this project? Was there something about the client that was weird that we should pay attention for next time? Did we misscope this? Was there something about our process that we can improve? And getting the team engaged in a conversation around simple numbers like this is a super powerful way to get them bought into time tracking, get them bought into process improvements, get them bought into measuring things, and really get them thinking in the right way about becoming more efficient about the way that we get work done. So this is a really simple but powerful example of how average billable rate can be used to get insights, facilitate conversations, and move the business in the right direction. So we've talked now about core financials and earning efficiency. The next thing we're going to do is talk about utilization. But before I do that, everybody clear on average billable rate? Give me a yes in the chat if that is tracking. And if you feel like you're ready to start looking at your average billable rates across your business, Adrienne says yes, keeping it simple. That's the goal. We want to make this stuff simple. Sarah says yes. Marianne says yes. Amazing. Thanks, everyone. Okay, one more metric, and then we can focus a little bit more on Q&A. So utilization. Let me know in the chat if you've ever heard the word utilization before. This is something that is familiar to you. It's a very, very hot metric in the agency space. And I refer to utilization as the dark saber, if you're a Star Wars fan, of agency metrics, because I believe that it has great power, but in the wrong hands, it can do great damage. And often where I see this doing a lot of damage is where it's being used as a metric to hold the team accountable to being busy. And there's all kinds of reasons why I think that's really, really detrimental and actually has the opposite effect that it's intended to have. But we'll talk about that in a moment once we define this. So the formulas for utilization is very simple. It's capacity, it's delivery hours or billable hours, as you might call them. Delivery or billable. I don't like to use the word billable hours because it has a connotation around how the client is billed. And the way that we want to define a air quotes billable hour, or as I like to call it, a delivery hour in this scenario, is it's any time that's required to get a project done or a deliverable done for a client. And it doesn't matter if the client pays you more or less money for that. Because the reality is, if you're billing on time materials, but you eat a bunch of hours, that's affecting your profitability. And that time was still required to get the work done for the client. So in the context of utilization, I really prefer to use the word delivery hour, because then it doesn't matter if the client's being billed for the hour or not, or if they're being charged a flat rate or an hourly rate. It really just comes down to, did we have to spend time on the client? And if the answer is yes, then the hour is considered included in this definition. So it's delivery hours or billable hours divided by capacity. And I like to keep this metric very simple for a couple of reasons. It's horizontally more valuable if we leave it simple like this. And we can also look at the entire agency and a subsection of the agency, and the measurement doesn't change. So the nuance here is on capacity. When we ask what's included and what's not included in that, when I refer to capacity, I'm talking about the total capacity for the area that we're measuring. So for a single individual, this is usually 2,080 hours per year, or 40 hours a week times 52 weeks per year. And I know what you're thinking, Marcel, what about holidays and vacation time and time off and non-billable time and all that stuff? I'm paying people for 52 weeks a year, but I'm giving a whole bunch of them that time back in the form of this time off and benefits and so on. So why would I measure capacity as though they're going to be around all the time when they're not? And the reason for that is because we want to measure the cost of all that time off in our calculation of utilization. We also want to measure the cost of all our non-billable staff in this calculation of utilization. And if we leave this metric simple, then there are fewer inputs that we need to collect, because now every week when we measure utilization, we don't have to go figure out who had time off, if there was any holidays, if there was any sick time, if there was any, changes. And if we zoom out and look at the whole business, or we crop in and look at just a department or just a group of people, the calculation can stay exactly the same, and it becomes more horizontally consistent. So this is my take on how utilization should be measured. It's delivery hours, which is any time that's spent working for clients, divided by capacity, which is all of the time that is available across every team member that falls into whatever section we're measuring for the business. And so really what this is meant to do is give us a sense of how much of the payroll that we are buying from our team is being used for things that earn us revenue. And really how this plays out in a real world scenario is we have a certain amount of capacity in a given moment, and we might have a certain amount of delivery hours that are planned. And we may have a target for how utilized we want the team to be. And so in a situation like this, it's going to be a pop quiz. So get your fingers ready for typing in the chat. If we're in this situation where we have this gap here, we don't have enough delivery hours to meet our target, what are the two levers that we can pull to get to our target, to improve our utilization? Has anybody had a guess in the chat? How do we close this gap? How do we achieve our utilization target? Taylor says sales. So that is absolutely one lever. We could sell more work. Right? So if we add more hours, then that will get these hours up closer to target. There's one more lever. It's not one that we like to talk about, but it's there. And most of us, and you can let me know in the chat if this has ever been done to you. Yes, Sarah, there it is. Lowering workers, right? So lowering our capacity. This one is way less fun than selling more work, but sometimes it's what we need to do, lowering our capacity. So these are the two levers that we get to pull in order to improve our utilization. But here's the catch, and this is why I talk about average billable rate and utilization together. Selling more work is the key here. And this is the reason that I don't like using utilization as a performance metric for the team. If I just tell my team, hey, folks, you're not hitting our utilization target, I need you to hit 65%, the team is going to spend more time doing the same work. And if we go back to our calculation for average billable rate, if I go from spending 800 hours on this to 1,000 hours on this, because I'm pushing my team to meet an arbitrary utilization rate, if I haven't given them more actual revenue to earn with that time, if I haven't given them legitimate reasons to work more billable hours, then I'm just going to reduce my average billable rate. And so instead of making $125 an hour on this project, I'm now making $100 an hour on this project. And if my average cost per hour stays the same, my margin has just been affected by this. So now I'm making a 65% margin instead of a 72% margin. So this is not a good thing. This is very detrimental. I would rather be in a position where I have low utilization and a high average billable rate than the opposite, because there's several levers we can pull. We can sell more work, we can cut capacity, we can deploy those resources against internal projects. There's room for us and flex for us to make adaptations if we have lower utilization and a high average billable rate. But the opposite is a far worse scenario, because the team is busy, they're taxed, there's generally less headspace for actually working on these problems. And then our clients tend to get used to over servicing. So this is the key, is always look at utilization and average billable rate together, so you can track if one improvement in one is coming at the cost of the other. Is that making sense so far? All good, says Taylor. Adrian says yes. Amazing. So I just want to cap things off on utilization. I want to talk about a couple of things, benchmarks and targets for this, as well as a report example. And excuse me, I'm struggling here with my voice a little bit. So let's talk a little bit about what a utilization report might look like. So in this example, we're looking at a month. We've got a couple of full-time people here and a part-time person. We have the amount of delivery hours that they worked, and then the utilization calculation for them. And then we just total that up across the team for the given time period. So this is how we would report on utilization. And again, I keep this simple intentionally because this makes it easier to do. There's fewer inputs that we need. We can keep this modeling very simple, and then we get more horizontal insight. It's easier to see how this is changing over time. In terms of benchmarks and targets, generally we want our pure producers. So this is people that I would consider to be like designers, developers, copywriters. Their job is to come in and do things for clients, move deliverables forward. We generally want them to be at 75% plus utilization in a given week. This is a normal week with no time off for holidays or anything like that. For delivery managers, anything above 35% is good. So this would be like a creative director or like a head of design, that they're doing work for clients, but they're also basically managing and running the delivery team. And then anyone else in the organization, operations people, salespeople, admin, really anything over 0 is a bonus. But here's the important thing, is on a weekly basis, we want the entire agency, when we look at everybody on payroll, including non-billable staff, to be at about 65% when we look at the totals, 65% or more on a weekly basis. And then on an annual basis, we basically want to subtract anywhere from 10 to 15%. A good rule of thumb is about 15% off of the weekly targets to account for holidays and time off and sick time. So pure producers should net out at 60% plus, delivery managers at 20% plus, and the entire agency, if on an annual basis you can't get more than 50% of the time that you're buying from your team to go towards earning revenue, you're going to make it very hard for yourself to be profitable. It's not that you can't do it. You can. You're just going to have to charge much higher rates to compensate for the fact that you're not putting most of your payroll towards earning revenue. So you really want to make sure that you can get up over that 50% net target for the year. And that should give you the context in which it's reasonable for you to be profitable, as long as your average billable rates are fairly healthy. So that caps off utilization. I want to bring these two concepts together just to really show you how powerful this is in terms of frequent measurement. So to run through a scenario here, let's imagine that we have 10,000 hours of capacity in a given time period in our agency. And we're going to do this across 3 scenarios. So in all 3 of these scenarios, capacity is exactly the same. So what that assumes is that payroll is the same, overhead is the same. None of the costs in the business are changing. But what is going to change is utilization, average billable rate, and we'll see how that impacts our agency gross income. So in the first scenario, we have a 50% utilization rate. So that means 5,000 hours are being used to earn revenue, and our average billable rate is $100 per hour. So this agency can earn $500K in this time period with their 10,000 hours. Now, if we were to bump this average billable rate here to $125 per hour, then this same agency with the same cost structure can now earn $625K. So nothing has changed about cost, but we've just added $125,000 to the bottom line, which relative to $500K is a substantial improvement just by pulling on this one lever of average billable rate. And this next scenario, we're going to increase utilization to 60%, and we're going to go to $125 per hour. And that gets us all the way to 6,000 hours by 125, which is $750,000, which again, relative to the original 500K, is a substantial improvement. So when we come back to this calculation of delivery margin, where we talk about the key component here being the relationship between our costs, our delivery costs, and our AGI, we've just dramatically increased the AGI without moving the delivery costs. And this is where we start to create a really nice stretch for our delivery margin. So paying attention to utilization and average billable rate is a really simple but incredibly powerful way to steer the business in the right direction in between those financial touch points, and really get a lot of visibility into specifically what people or departments or role categories in the business need to be balanced in terms of capacity, and specifically what kind of projects or clients or service areas need to be paid attention to in terms of their average billable rate. So hopefully this has been helpful, gives you a really simple starting point on how to measure the profitability of your agency. And I just want to encourage everyone after today's presentation to go and grab, because there's a lot more where this came from, to go and get access to our agency profit toolkit, which has a bunch more training videos, as well as some spreadsheet templates, cheat sheets, worksheets, and so on to help you actually implement and start measuring some of these metrics absolutely free. So please go grab a copy of that if you're interested in going deeper. And with that, we've got about 15 minutes left for Q&A. So I'll open it up and turn it back to Kelvin at this point.
Well, I think if there's Q&A, you can handle it. I think Adrian actually asked a question in the chat there. If you want to take a look at that one, she's got another question around billable hours.
All right, let's have a look at here. So every agency I've worked at has tracked 100 different options for people to track non-billable work. At the end of the day, it seems like this is usually a justification for not having a high bill percentage. No action is typically taken from the non-billable data. What's your opinion on how deep to go in tracking non-billable categories? Yeah, really good question, Adrian. I think that really is, that's more of a cultural decision, but as it relates to the profitability of the business, I typically don't worry about internal time being tracked at any level of detail very much at all. If it's important for people to be tracking these things for internal projects, or you want to measure your costs or your investments on internal projects, that's cool. But I think oftentimes it comes at the detriment of time tracking compliance on the billable stuff, which is by far the most important thing for us to be getting good, clean data on. So the first priority for me is always, let's make sure that client projects are getting good, clean time tracking data against them. And then if we can track internal non-billable work, then that's a bonus. But the other thing that I think this alludes to is I find far too many people, they get a little too excited about data when they start kind of embracing that, hey, this is going to be an important thing for us. And they try to get to a place where the data is giving them all the answers. And one thing that we say internally all the time is the data can only tell you what the data is. It can't ever tell you why the data is. And that takes judgment, and often it takes conversations. And so I think a mistake is trying to get far too precise and granular in the time tracking data, whether that be on the billable or the non-billable side, instead of keeping it high level and focusing more on keeping things simple, clean, aligned, and really making it easy for the team to track their time, and relying more on conversations, project retrospectives, meetings, to get the context and the nuance behind the data and understand what to do about it. So hopefully that is helpful, but the short answer is I think non-billable time is far less important and should come after measuring billable time. Eric has a question: any recommended ERP systems designed for agencies that you could recommend? Full stack ERP system, one that could integrate seamlessly with your accounting, time tracking, project management systems, and personal preference. Okay. Yes, the tools question. I get this every time. So I've seen a lot of tools out there. And I think that the first thing I would caution you on is, if you're hoping to find something that's going to completely automate reporting, then I would drop that from your set of requirements for the kind of workflow side of tooling. And the reason for that is, even in a world where time tracking and invoicing and project management data all kind of flows directly into reports, inputs are never going to be perfect. Like, your team's never going to perfectly track their time, perfectly use the naming conventions. And I think that's one of the critical assumptions that undermines a lot of these ERP systems to try to air quotes automate, agency data. And when you try to automate those things, you'll find that you spend a lot of time looking at your reports going, why does this look so weird? And trying to pull on the thread back to the source data to figure out, oh, okay, Justin logged a 99-hour time entry over the weekend because he forgot his timer was running, as opposed to getting value. So I really feel that an ETL framework is the right way to go for managing agency data. So you have an opportunity to clean, transform, and normalize data. And then the ERP system should really be focused on workflow. How do we make a workflow really efficient? So with that in mind, some systems that I think have done a really good job on the workflow side, I like productive.io. I actually think Rike is pretty decent, although I have some concerns about their architecture. I have some clients that are using Rike, and that seems to be working pretty well for them. I'm also a fan of ClickUp as of late. They're releasing features far too fast for that to be really sustainable. I'm sure their code looks like spaghetti right now, but they raised enough money that they can probably get away with it in the short term. So those would be kind of some of my top picks initially. Productive.io feels like kind of the right in between in terms of having a rich feature set without being so large that they're just kind of bad at all of the many features that they're trying to be good at. So those would be some of the initial ones that I've had good experience with. But I personally, especially for smaller agencies, like to go to individual tools that are actually really good at the one thing that they do. So using a proper time tracking tool, using a proper project management tool, using a proper accounting tool, etc. One other one that I should mention is Teamwork. Teamwork's been pretty good as well for a lot of our clients. How would you suggest going about setting an hourly rate for C-suite employees who want to do consulting, but their typical utilization is 0%? So Taylor, I actually have a blog post on this, how to calculate employee cost per hour. We have a calculator for it as well on our website. So I'll see if I can get some links dropped to you for that. But the simple answer is basically the way we think about cost per hour is you take somebody's total comp and we divide it by their capacity. And I think there's this tendency to want to make this average cost per hour calculation much more detailed, right? Getting down to delivery capacity, stripping out time off. One of the big mistakes that I see people make here is they try to get a person's cost per hour to be reliant on somebody's utilization, which is like kind of setting yourself up for failure, right? Because utilization is going to change like every week. So does that mean you're going to go and update your cost per hour calculations every week? It's just not sustainable. So the way we look at this is let's keep this really simple. Go total compensation. So that's salary plus benefits and all that good stuff divided by their total capacity. So for most people, 2,080 hours per year. And then it's just a question of when we're setting our delivery margin targets for projects, we want to set it so that it absorbs some of that inefficiency that might happen underneath that. So in this example, if I've got an executive that makes 200K a year in total comp, and they've got a capacity of 2,080, then this person's cost per hour for the purpose of estimating is going to be $200,000 divided by 2080, which is $96 an hour. So they have a $96 an hour cost, average cost per hour. And so if we're going to build them out at a rate card, we basically just want to divide that by like 0.30. Because on a project basis, we probably want to be targeting about a 70% delivery margin. So that $96 per hour divided by 30, we want to charge about $320 an hour for this person. And then of course, if we're looking at adding up all of our costs for a project, it's the same kind of calculation. If we want to get to about a 70% margin on a project, we want to take our costs, divide them by 0.30, and that gets us in the ballpark. Because at 70%, we can afford to lose 10 to 15 between a project level and a P&L for, inefficiencies, utilization gaps, holidays, whatever, and then still be able to spend 20 to 30% on overhead and still have a really healthy margin. So we're giving ourselves some room to mess things up, because we're all going to mess things up from time to time, and still end up on the right side of the profitability calculation. So hopefully that's helpful. Thanks, Taylor. All right. And we have a few more comments. How would you suggest? Yeah, okay. I think that's it. Any other questions while we've got a few minutes left? I'm having fun. Hope you all are too. Whoever would have thought we'd have fun talking about agency metrics and numbers?
Here you said it was the boring stuff compared to Christian. I thought it's been really good.
So one other thing that I'll speak to while we wait for some questions to come in is, we didn't really get a whole lot of time to talk about it, but is this idea of scoping accuracy. So this is the last thing that I'll speak to. And this is a super simple thing to calculate. And really what we're looking at is the delta from estimates to actuals. So for example, if I estimated 100 hours for a project and my actuals were, let's say, 125 hours, then the delta between those things is about 25% over budget. And really the objective with scoping accuracy is to try to consistently get to, right, the target for this, try to get to around 10% variance consistently. I don't know, to some of you that might seem really, really crazy, but it is feasible. And this is done typically by collecting really good data on estimates versus actuals so that your estimation can become more programmatic and data driven. Of course, getting more defined about your scopes of work, revision cycles, your contract structures, all that kind of stuff. And the importance of this, again, is mostly about planning into the future around resourcing and capacity. It's going to set a really, really strong foundation for your ability to have effective and scalable operations. So measuring this and having a way to, at the end of a project, figure out how far off were we, and then measuring this pattern across different areas of your business is a really helpful way for you to figure out, hey, where do we need to be spending more time thinking about how we scope and how we run our process for doing this thing, so we can get more consistent in terms of the amount of time it takes, or we can just get better at estimating things. Nicole has a good question here. How about owner comp, where they spend 10 to 20% of each month on client work, but the rest of the time is spent on running the biz? Salary is subjective. Yeah. Okay. So Nicole, a couple of things. Salary allocations are how we're going to get to one of the things we talked about earlier, right, was delivery costs. And so typically I recommend that we have 3 payroll accounts in the business. We have delivery payroll, we have sales and marketing payroll, and we have admin payroll. And so as a founder, you're probably going to have some kind of salary allocation. So one of the concepts that we have at Parakeeto is what we call the payroll grid, where we have every individual in the company listed. We have the amount of salary that they make, their benefits. We have the hours a week that they work. We have their delivery target, which is how many hours we expect them on a regular week to be billable. And then we have the allocations. What percentage of their salary belongs to the delivery department? What percentage belongs to sales and marketing? And what percentage belongs to admin? And so in your case, if you said, hey, I'm the founder, you would just have allocations. And in your accounting tool, your accountant would be splitting these things up to say, okay, so delivery is 20%, admin is another 30%, and then sales and marketing is the other 50%. So your salary would get split out across these several lines. Now there's the second question there, which is about, I'm a founder, my market rate's probably $150,000, $200,000 a year, but maybe I'm not paying myself that right now because, that's like the crazy thing that we do as entrepreneurs, is we make way less money so we can work way harder and take on all this crazy risk. And then if it happens to not work out, we get no benefits from the government and we wonder why the heck we did this in the first place. But we're all just a little bit crazy, so it's okay. So if that's the case, typically what we want to be doing is, of course, in our accounting tools, we're not going to see the actual cost of that. But what we can be doing is creating essentially a line for like deferred salary. Because the thing is, like, this is another thing that I find a lot of people do, is they think, well, I'll just pay myself via dividends so I can save on taxes. And that makes sense. If you want to save on taxes, pay yourself via dividends. But if you do go into some kind of an acquisition conversation, it's not going to help you that you're paying yourself a lower salary, because any like good acquirer is going to adjust for that and look at what would it cost you to essentially hire somebody to do the job that you're currently doing, because the assumption in an acquisition is usually that you're not going to be around. And so in the on the balance sheet or inside the accounting tool, having some kind of deferred founder salary line so that you can true that up, but then easily isolate it and subtract it out is a good way to model the total cost of that. And when you're doing your non-financial modeling, when we're looking at things like average billable rates, or you're doing estimation, and sorry, I'm jumping around here, but when we come up to some of this stuff and we're looking at, for example, our average billable rates, or we're estimating a project, then what I would do is set your cost per hour to be what it would be if you were paying yourself a market rate salary, so that you're really pricing things for the true cost of replacing yourself. And the worst case scenario is that one day when you do hire a CEO or hire somebody to do that delivery work, that you'll have already priced things to account for what it's going to cost to get somebody to do that. Does that make sense, Nicole? Salary is subjective. Yes, it sure is. All right. I think
that was the best summary on entrepreneurship I've ever
heard. Yes, entrepreneurship in a nutshell. It doesn't make sense. It doesn't make sense. All right. Easy calculations, Adrian. I'm happy to hear that. That's my goal. I'm going to throw it back to you, Calvin. That's pretty much all I got. I'm going to drop some links in the chat for everyone.
Yeah, no, that was great. We're coming up to the top of the hour, and I'm sure you could have gone on for hours. That was really great. So thank you so much for taking time out of your day and providing everybody that showed up some value, and even the people that are going to be catching this on a video. I think there was tons of really good information in there. So from my standpoint, everybody give a big clap here for Marcel, and a big thank you for him providing his time to us and his insights. It's been really great. And thanks for participating. It's been great. There's been a lot of really good insights here today. So thank you. And that being said, that's the conclusion of our boot camp here today. So thanks to everybody that's attended. Thanks for taking potentially half or more of your day out today to watch some of our panelists here and listen to some of the insights that they have. I think it's been really great. So thank you to everybody for attending, for taking the time out of today. And I will leave it at that. Thank you, everybody. And I hope you all have a great day and great week.